value investing is all about finding the silver lining, and today that is insights on how to navigate, a very long duration bull market. So at Antipodes, many of you will know we offer 3 global offerings. We have our Antipodes Global Value Fund that stays more fully invested through the cycle. We have our Global SMIDS Fund, which is coming up to 3 years of track record and is the #1 fund in its category. And then our Antipodes Global Fund, our long-short variable beta offering with more of a focus on capital preservation. A fund very appropriate for, as Kyle mentioned, that transition to the pension phase where downside protection is important. And that is, as we know, the majority of the industry. In terms of the cycle and where we're at, as you have a very long duration bull market, typically beneath the surface you see a build-up of macro risks, like seismic pressure building. Those cracks can start to widen. At the same time that valuations are becoming stretched and returns in the benchmark are becoming more concentrated. This is where variable beta comes into its own. It's able to navigate that late cycle and those drawdowns that happen. Now, I'm not talking about the shallow drawdowns we've had in the last 15 years. I'm talking about the bigger ones, like the one coming out of the dot-com bubble in 2001, 2002, or the global financial crisis in 2008. It's been a remarkable 3 years. Global equities have been compounding at roughly 19% per annum in ACWI. Over that period, our funds have broadly kept up, and we've beat the value benchmark because of our pragmatic approach. It's notable over that period, the global fund has also been investing with an average net exposure of 76%. Now, what is often missed in the market's alpha mindset is the risks associated with generating those returns, and our global offerings have generated those broadly in-line returns with much lower risk than the benchmark. Hence our Sharpe ratios of over 1.5 are ahead of the ACWI and almost double ACWI value, and our SMID fund is running at about 2. Now, risk management can sometimes play a backseat in an environment where returns and markets are trending strongly. Investors aren't focused on how easy it is to make money in the benchmark as opposed to risk. We think that's exactly the time when you should be thinking about downside protection. As the bull market matures, as macro tail risks start to build up, as valuations become more stretched, as returns in the benchmark become more concentrated. Also, investors often start to think in a very narrow sense about risk, and it starts to become one-dimensional tracking error. Now, we understand that tracking error is an expression of risk, and it's a useful one. But when benchmarks become concentrated, there is just old-fashioned value at risk. And there's a lot of it in the benchmark, and there's a lot of it, obviously, in benchmark-hugging portfolios. So I've invested through each of these downturns, and in the last 5 at Antipodes, our global offerings have outperformed in all 5. And that is because capital preservation is a part of our approach and is applied across all of our strategies, whether they're long, short, or long only. But in particular, in that long-short strategy, over the past 3 years, we've been operating with a downside capture of 11%. So that is remarkably low. That means in a market that's down 10, that fund has on average been down just over 1%. In fact, in this most recent episode, Liberation Day, where the market was down 10%, the Antipodes Global Fund was up. And since we've had the taco rally, we've also captured a relatively large part of the bounce. So we think that's very important. It's an outcome of our pragmatic value approach, discipline in our stock selection around valuations, and also capitalizing on emerging tail risks in the market. So what do we mean by pragmatic value? It's very much paying the right multiple relative to growth and business resilience across the continuum of those characteristics. And it's also taking advantage of cyclical changes, structural changes, and socio-macroeconomic changes, which tend to see pockets of inefficiency creep into the valuations of companies that we can take advantage of. But it's also through an industry-led and a genuinely global approach to research, finding diversified sources of alpha. Now, why is that important? Well, you can see in the benchmark there on your left, there's a lot of blue, which is the Magnificent Seven, and dark blue. So light blue, dark blue, that is a combination of US software and hardware. It is the, let's call it US mega cap, quality, growth, AI enablers, I'm not sure if I can put any more labels in it, trade that has dominated the returns in the benchmark. Over here on the right, you see the top 10 contributors to the Antipodes Global Value Fund returns, and you can see a lot more color, i.e. we've found diversified sources of alpha, diversified by region, by industry, by thematic. That's very important in an environment that we're starting to see. So year to date, against the backdrop of US exceptionalism, the S&P is underperforming ACWI, the Mag 7 is underperforming the S&P, and Europe and EM are significantly outperforming, led by Europe, the home of regulation, and value is outperforming both quality, significantly outperforming quality, which is a very expensive factor, and also growth. And pleasingly, our funds are capturing that broadening out that's taking place and are significantly outperforming their respective benchmarks. So look, we think there's tailwinds for this broadening to continue, in fact, to accelerate. It's a combination of a shift in fiscal impulse away from the US to the rest of the world. It's the fact that there's this tangible investment cycle that's emerging, and also the fact that in AI, we're shifting from the enablers to the adopters, which we think will be a much broader group of companies. As that broadening out happens, a change in leadership, the change in narrative will drive a change in some of these valuation distortions that we see in the market, and a bunch of new winners will emerge. So the case for fiscal broadening out is very simple. US exceptionalism has structural factors, like permanent factors, that have driven higher levels of productivity growth in the US. But there is a cyclical element, which is the exceptional level of fiscal stimulus. Since the first Trump presidency in 2016, the US has spent the equivalent of 60% of GDP on deficits. That's double what has been spent in Europe. And now what we're seeing is Trump's determination to make America great again is actually pushing the rest of the world to loosening fiscal policy at the same time that the US bond market is starting to put limits on the ability of the US to continue to stimulate. The case for regional and style broadening out is just this emerging requirement, generally in the West, to reorient away from consumption-led economies to investment-led. This is a massive, once-in-a-generation shift. Governments are worried about their dependence on China. They're worried about, particularly in Europe, about their defence inadequacy, their defence industry, and the need to catch up on defence spending. Energy transition is ongoing, even within the US, in democratic states, and even in Republican states, renewables are generally competitive, and so the transition continues, even with Trump in the White House. And then we have AI infrastructure. As we know, we need to keep building data centers as AI becomes a part, as the real world use cases for AI start to broaden out. And then AI adoption. We are moving to those, a broader range of companies where, because the cost of AI deployments are plummeting, even in the last 12 months, a 100x drop in the cost of running an AI model. It means broad corporates who have rich data sets, who have built their businesses natively in the cloud. Credit card companies like Capital One are going to be able to capture the benefits of deploying AI in their business, and if they're in a strong market position, they won't see all those benefits competed away, and you're not paying a hype multiple, you're paying a normal multiple for a company that is going to be able to drive earnings from AI adoption. So what is the major risk that we see from a tail perspective? It really is two. It's the fact that a lot of debt late in the cycle, where has been debt built up in this cycle? It's been in sovereigns. So I would call out the US, Great Britain are two great examples. Where else has it been built up? It's been built up in the bottom 20% of corporates. So corporates who are funded by private equity, private credit, especially in the US, where private credit is a much more aggressive lend than it is in, say, this country. Typically at least 6 times debt to EBITDA. So it is proper bottom end of junk. That's where the risk is. And we estimate that roughly 20% of the US workforce is employed by that type of company. Now, let's look at the job market. Obviously, coming out of COVID, we had, for every seeker, there were 2 openings. Now we're in an environment where it's a 1-for-1 relationship. So the job market's much more balanced. That means if there's any loss of confidence with corporates or with households, it will quickly feed into lower job demand and unemployment. And that, is obviously then leads to weaker activity and then potentially puts pressure on these weaker corporates, and you start to see the emergence of effectively a self-reinforcing down cycle, which is ultimately, results in a recession. Now, we're not calling that as our base case, but we are pointing out that the risk is priced arguably outside of the US. Equities are pricing in a lower growth environment. Inside the US, even adjusting for the Magnificent Seven, US valuations, you're not being compensated for the risk in the backdrop. And we see this broadly across sectors. If we take like-for-like comparisons, for companies have had similar ROEs and similar growth profiles, so adjusting for growth, adjusting for profitability, on average, the ex-US opportunity is significantly cheaper. Our portfolios, we're overweight on a regional basis in Europe. Now, that isn't because, yes, we're constructive on the top down in Europe, but we're actually building these portfolios from our industry research from the bottom up, and most of what we own in Europe is a multinational. And when we benchmark that multinational and we benchmark its valuation versus its global peers, it's more attractive. Overweight Europe. In Asia and EM, we also like, in Japan, we see similar opportunities to buy world-beating multinationals at cheaper valuations. And then in emerging markets, it's the one place in the world where the quality factor, companies like Tencent, are significantly cheaper than they are for quality, especially in the US. And by definition, as a result of those bottom-up decisions, we end up being underweight North America, but still with obviously a significant exposure there. On a thematic basis, in our top row, we have those lower growth, more cyclical businesses, but we are screening out the value traps, and we're finding companies are cheap relative to that growth. In the middle row, there are our structural themes, the AI, the onshoring, the investment trends that we're seeing emerging. But we're looking for opportunities that are transitioning from the market perceiving them to be more cyclical, to be more structural, and so they are still mispriced relative to that longer term trend. And then in the bottom row, our more defensive exposures anchored around utilities and healthcare. So over the last 10 years, Antipodes' pragmatic value approach has delivered attractive risk-adjusted returns with very good downside protection with diversified sources of alpha. And we think that's very applicable to the current environment where returns are highly concentrated and tail risks are starting to build up, and diversification does matter. We look forward to doing this in the years to come, and to borrow a phrase, join us on the journey.